It has been a rough few years for mergers and acquisitions. We've seen economic uncertainty, regulatory challenges, of course, market volatility, financing costs, and higher interest rates. So, what if I told you that despite all of these challenges, there's one M&A firm that continues to see record growth, listed 4 times in a row by Inc. 5000. It is the fastest growing M&A firm in the country, and its founder today is right here on Expert Connections. Calder Capital's story is one truly of remarkable growth, and I'm learning that has a lot to do with strategic agility and innovation. Welcome to Expert Connections. I'm Julie Holton. Our expert today is Max Friar of Calder Capital. Max, welcome to the show.
Thank you very much. I'm very glad to be here.
Calder Capital is a leader in mergers and acquisitions with 48 deals completed in 2023. Let's maybe paint the landscape, an overview of M&A and the process, because I think it's really important for businesses to understand the process.
Broadly speaking, mergers and acquisitions is a fancy term for buying and selling businesses or investing in businesses. It's interesting that it's called mergers and acquisitions because, in my experience, there are very few mergers, and it's mostly acquisitions, especially in the space that we focus on, which is kind of primarily this like $5 to $50 million company size space, which is typically referred to as the lower middle market. So I think for the audience, the thing to think about is, why do people or companies want to make acquisitions or make investments in other companies? And there's generally speaking in this lower middle market area, two reasons. If you start from the really kind of the smaller deals, even the sub $5 million deals, there's a lot of individual entrepreneurs that are looking to more or less buy their freedom. So they've been working for someone else for 10, 20, sometimes 30 plus years, and they become frustrated, or they've reached a point where buying a business is something that they've dreamed about, and they look at it as a way to kind of carve their own destiny. And so we do work with quite a few individual investors, individual entrepreneurs looking to do that. I think as you tend to go up the scale a little bit, you're working with strategic buyers. Strategic buyers are folks that are looking to kind of buy generally within their industry or kind of tangentially. And they're typically trying to accomplish a couple of things. They're looking for talent, they're looking for new products, they're looking for new markets, and sometimes being able to grow at the pace they want to organically, that's difficult to do. And so they look to make acquisitions of other companies to accomplish those goals. The third type of buyer is the financial buyer, the private equity firm or family office. And those are essentially groups of people that are out there searching for companies to invest in to make high returns for their investors. And on the private equity basis, the investors could be high net worth accredited investors that they go solicit funds from. And on the family office side, it's typically of a wealthy family that's decided to start an office that's dedicated to buying and growing and holding businesses. So that's essentially a high level overview of the world of mergers and acquisitions that we work in.
You mentioned that often they're not actually mergers, so it's interesting that they're called mergers and acquisitions. What are some of the most common misconceptions about M&A?
Uh, well, I think a lot of the misconceptions come down to valuation, I guess I would say, and I guess I didn't touch on that when I described mergers and acquisitions. Really, the foundation of a transaction is going to be surrounded by valuation. So what is the value of that business? And there are ways to do business valuation analysis and calculations, and we do a lot of that work at Calder. And we do that to set expectations. And I would say a lot of the misconceptions about mergers and acquisitions are about where the value lies, if that makes sense. So it's very important for your audience to understand that regardless if it's an individual chasing their dream or it's a private equity firm, they are essentially looking at return on investment. I guess what's the other side of that? The other side would be it's hard to place value on businesses that are not producing profits. It's very hard to produce, or it's very hard to put value on intellectual property unless there are profit streams behind that intellectual property. So there are a lot of misconceptions about where value lies, and essentially value lies in hard assets and in cash flow.
Okay, so let's talk about that. So are those then the two key factors you would say in what drives value in a business?
You essentially, if you're a business owner, you really don't want your assets to drive value because, you know, essentially you're buying assets. Like say for example, you're a manufacturer, you're buying equipment. Well, the second you buy that equipment, it starts to depreciate in value, right? So what you really want is you want to buy that equipment so that it produces earnings, so that investors will, or buyers will later look at the value of your business in terms of the earnings it produces, not in terms of the assets. I say that there's value in assets because, and this is typically unfortunate situations when companies don't produce adequate returns on their assets. The valuation then goes from the value of those cash flows to the value of the assets, and that's usually at a depreciated value. So the most important thing to focus on, if you're going to pick one thing to focus on to build value in your business, it's profitability.
Can you share, are there long-term strategies, or do you look kind of in the lifetime of a business? How do you really start to build value, that something that business owners maybe that you often see they aren't doing that they could be doing?
Sure. Yeah, that's a great, I love this question because it's you know, there are many things an owner can do, but there are some core things that business owners can focus on if they want to build their value and have a you know, a productive and happy exit when they eventually do sell the business or pass it on. So really the first one is that financial performance. And so owners can sometimes get trapped in trying to chase revenue, you know, and not chase profitability. So um, you could ask a question of, you know, if you have a company that's producing 25 million in revenue and you have a company producing 7 million in revenue, which one's more valuable? And the question is, it's going to be based on how much profit that they are producing. So revenue rarely drives, at least in the lower middle market where we work, revenue rarely drives value, if ever. I barely ever see buyers or investors assigning any value to revenue. What they assign it to is the earnings. And I would say, you know, behind that is proof of earnings, right? And that comes down to quality of financial record keeping and financial information. If your books are a mess, if there's a lot of accounting errors, if you haven't been tracking things appropriately in your business, if you haven't been focused on making sure you have clean, accurate financials as you head towards a sale, it's going to be a hard time. So really, those are top two things when it comes to financial performance. I would say secondly would be, think about diversification of products or services and customers. We have sold companies that are relying on one product. We've sold companies that are relying on a couple of large customers, but it's much more difficult to sell those companies. And oftentimes the deal structure contains a lot of risk in it for the seller. For example, if you have one or two customers that make up 90% of your business, there's a high likelihood that the buyer is going to either give you a low overall value or ask you to sell or finance a significant part of that transaction based on that risk. So trying to diversify products, services, customers is a great way to build value. And this next one's going to sound logical. If the business is reliant on you as the owner to do, you know, all the sales calls and make all the products and do deliveries and do all the billing, it's hard to build value when it's all you. So to the extent that the business owner can add a management team or at least some key managers and delegate some responsibilities, you know, it kind of, from a buyer's perspective, that's a de-risking type thing, right? They look at it and say, well, I can buy this company, I can pay the owner, there can be a customary transition period, and then the business owner can go on their way, and I have a team behind me to continue to operate this business. You know, outside of those really small transactions, you know, many buyers don't really want to come in and you know, run the business every single day. It's really those entrepreneurs that are looking to buy their freedom or buy a job. They're expecting to do that, but you start getting above 3-4 million in transaction value, and you really need to have some key people in place, for continuities. And I would say, the plug for Calder here would be, when you decide to sell, make sure that you hire a firm that can run a very robust process. I mean, a lot of it comes down to a numbers game, and you might be surprised to hear this, but less than 10% of buyers that inquire about one of our opportunities, that sign an NDA, that answer qualifying questions, actually move forward with any seriousness with a discussion. And so what we try to do is create a very large marketplace of prospective buyers, because we know that we really need to be in front of 100 to get 10 that are interested. So those would kind of be the 4 things to focus on.
I'm curious about the deal structures themselves. Are the deals pretty standard, or does this change depending on industry or types of business? How do you structure a deal? What goes into that?
That's a great question. So there are a lot of ways to structure a deal. When you're looking at transactions, let's look at some of those entrepreneurial-led transactions, say sub $5 million, right? A very common mechanism to finance those transactions is an SBA 7A loan. And the reason is that with those types of loans, they don't require a lot of cash down payment from the buyer. So a typical structure for an SBA 7A loan would be less than a $5 million purchase price. And the buyer would bring 10% of the purchase price. The seller would finance 10% of the purchase price in the form of a note, and then the lender would come in and bring 80%. So the buyer would receive 90% of the proceeds at closing, and then over some period of time, they would receive, the rest of the 10% via payments made to them. So that's a very common structure. When it can sometimes, can depend on a lot of things we talked about. It can depend on financial performance, cleanliness of records, customer concentration. Part of the elements of it, characteristics are risky items like high customer concentration or high product or service concentration. The buyer might ask for an earnout as part of the transaction, and an earnout is the seller receiving the rest of the proceeds of the sale based on the performance of the company over time. And sellers generally don't like an earnout, and we try to avoid earnouts for the sellers that we represent, but it's not always possible. And again, one of the hedges against a poor deal structure for a seller is competition. If you can get 10, 15 offers on the business, you can usually make that deal structure a lot more secure for your sell side client.
When do you tend to see those earnouts? Is that more, as you were describing earlier, when maybe there isn't a team in place, or perhaps it's the business is reliant upon one product, or only a handful of large customers? Is that when you would see that?
So I'm mostly seen it historically related to customer concentration. So if there's 50+% of the customers are one customer, if you think about it, if the buyer buys the business and that customer decides they don't like the buyer, or they're going to explore their options and go away, that could be a significant hit to the business. And so usually it's not relying on management team. I mean, if you have 3 or 4 key managers and one of them gets upset after the sale and leaves, it's not going to have, generally speaking, the same impact as losing 50% of your business with one customer. The earnouts aren't always on the kind of downside either. If you think about it, sometimes an earnout, if you have a really competitive transaction, and say you have 5 bidders and they're all at 19-20 million for the valuation, maybe you end up getting your top bidder to give you 21 million in cash and add an earnout on top, right? So an earnout can kind of serve as a cherry on top and sweeten the deal.
Mm. Okay, so not necessarily a negative thing that the seller would not be looking for. I'm curious, again, to go back to valuation. Do you see business owners overvaluating, in their minds, thinking that their company is worth more than it is? Do you see the opposite of that? What should business owners be thinking about in terms of valuation?
Yeah. I mean, yes, it is true what, kind of what they say, which is that owners tend to overvalue their company. And it's just really based on not having the appropriate knowledge or listening to people that don't have any expertise or experience in valuing companies, right? Someone might talk to their neighbor and they say, oh, he sold his company for a 10x, and a guy might say, or a gal might say, well, my company's in the same industry, so I should be selling at a 10x. And when it's just not true. So, one common myth with valuation is that the valuation models are combined, and I'll give you an example of that. So, let's say you had a manufacturing company that had $5 million of equipment, right? And you had on a market basis, the company had $1 million in earnings, and so from a market perspective, maybe that $1 million in earnings was multiplied by a 4 multiple. So a business owner might think, okay, well, I'm getting a $4 million valuation for my cash flow, and I'm getting a $5 million valuation for my equipment, so I should get $9 million. Like, that's not true, right? It's sometimes you can blend the models, and sometimes buyers will look at different valuation models and they'll kind of weight them differently, but they don't add them on top of each other. So that's a big myth, and that we see out there from time to time. And I think the other one I already touched on was overvaluing intellectual property. And what I mean by that there are some owners that have 10, 20 patents, and they're not making really any money, but they think that because they have these patents that their company's worth millions of dollars. And back to what we talked about, intellectual property is valuable insofar as it protects, earning streams. It's not valuable just because it exists.
Right, right. Okay, Max, I'm curious, what are some of the most fun deals you've been a part of, or what have been some, kind of success stories that have come out of Calder Capital that you can share with us?
Well, I mean, probably one of the most fun, you tend to remember your formative years and your initial ones, right? Because they kind of had the biggest impact on you. For one deal that I did before I even started Calder, it was a rubber products distribution company, and I ended up getting 27 offers on the business, which was just a total riot, right? I mean, when you have that much interest, and I guess this is when you can get that much interest, like, you can kind of control the buyers, if that makes sense, right? And that's a lot better dynamic than having little interest and feeling like you're kind of at the whim of the couple of buyers that are interested, right? Like, it's definitely fun to have the negotiating leverage. So that was really fun. But what made it super fun is that I ended up going sailing with the owner during kind of the last week of closing, and the deal was closed while we were like kind of sailing around the Florida Keys. So it's just super memorable that was the case.
What a way to celebrate out on the
Yeah,
water,
we were out on
sailing
the
around
water.
the Keys.
I had to go to a marina's office and use their fax machine to take care of some of the final paperwork. Yeah.
What a fun way to celebrate.
Yeah.
What got you into, in those early days, as you reflect back, what got you into buying and selling businesses in the first place?
I knew nothing about this business when I was hired to work in it, which isn't that interesting? And I still think it continues to be a business where it's hard you can't really go to school for this. And so you have to kind of find a way in. So I fortunately found a way into a company, and they hired me because I had previous sales experience, and I told them I would cold call business owners. And that's one of the things they wanted to be done, because no one was doing that at the company at the time. So that's how I got in, and I was instantly fascinated. And if you think about it, well, you're dealing with money, you're dealing with psychology, you're dealing with emotions. It is just multifaceted. And I think if you look at when college students graduate and they go work in the workforce, and then they're interviewed later on about, like, why do they like their job, right? A common theme is just diversity in the day. right? And they're not doing the same thing all the time. I would say this business is the pinnacle of not having the same day every day. There's always some variety. There's usually an issue. When you think you've seen everything, something else comes up, right? And I would say too, there's for someone that has a little bit of adrenaline junkie in them, we're as good as our last deal. So there are big ups and downs in this business, and there are times when there are huge successes and celebrations, and there are times where you think you're close to closing, and then something happens, and all that work and all that effort just evaporates. So
We have
lots.
another segment on this show that's focused on startups. And when I'm talking to startups and hearing a lot of their stories as they're looking ahead down the pike to what may come, what that future might look like,
Yeah.
we spend a lot of time talking about their personal and professional development and what they'll need to do as business owners in order to grow the business that they're working on. From your standpoint, for your personal and professional growth, Entrepreneurs Organization has been a part of that for the last few years. Can you talk about that and how that organization has been a part of building kind of you and your business?
So I knew a few folks in EO years before I joined it. I didn't really know what it would do for me, to be honest with you. And when I first approached it, I had been told that you're only going to get out of it what you put into it. And I didn't feel like the startup years for Calder, which would 2013 is when we started, for the first few years after that, it was just kind of like trying to just get things to work and, putting out fires and focusing and trying to build some infrastructure while also running deals and talking to new prospects and all that. So I had been introduced to EO, but didn't feel like I could give time to it, if that made sense. In 2019, I made some hires, and I kind of felt the juices of growth bubbling a little bit. And so I decided that I would make the time to join EO. Not, and there was almost this I don't know what I don't know feeling surrounding it. Like, I know I can learn something here. I know this would probably be good for me, but I didn't know what I would get out of it. And I went through forum training. I joined at EO, and I would say that we've had tremendous growth since then. So we've grown 750%, over the past 5 years, which has been crazy. I'm a growth person, so like going backwards is not interesting to me at all. Like, it doesn't feel good. It feels much better to struggle to grow than to kind of give up and flatline or go backwards. And I've already told the team that, if I start to feel like I'm not interested in that anymore, then it's probably time for me to step aside, and I'll honor that too. So at this point in my life, I'm very interested in continuing to grow, and we have extremely ambitious 10-year goals to grow. So with EO, I felt like when you go to forum, you're forced to confront your issues, right? And those can be personal issues, relationships, kids, friends. For me, I was more interested in business issues. And so kind of like if you come to forum every month and you have the same problem, your forum mates start looking at you like, what's going on here? Like, let's move past this. And they don't say that because, they're not, we all have to solve our own problems. So it's generally very supportive, and no one's telling you what to do. They're giving you experience shares, and they're giving you advice from how they've seen other people solve similar issues. But I guess for me, I did not want to show up every month and have the same issue over and over again. I needed to move past my growth issues. And so I felt like I needed to tell my forum mates that I was making progress and getting past. So that's just it's hard to put that into concise words, but that is probably one of the number one benefits of just, if you're a personally accountable person, you don't want to go to people that you respect and not have solved your issues. At least I don't. I also acquired some tools as well. So I noticed that everyone else in my forum was using a business coach, and I didn't even really know what a business coach did. And so I now use a business coach. I've had a business coach for 4 years now, and I don't imagine a situation where I wouldn't have that person. And why do I have a business coach? It's really just accountability, right? It's the whole Napoleon Hill: make a plan, put it next to your bed, look at it every day, and suddenly you get what you want. And it has a magic effect to it. I think the last thing I would say about EO is you go every month to forum, and you're kind of forced to reflect. And I think many business owners are just running around. It's easy to do tasks all day long and put out fires all day long and think you have to do everything. But there are $10 an hour tasks, and there are $10,000 an hour tasks. And EO forces you to reflect on what is the best use of your time. What's the best value for your time? So I would say those are the reasons that EO has been very valuable to me. And I would recommend EO to anyone, any entrepreneur that wants to grow and is looking for some accountability partners and some tools. And chances are, if you join EO, you're gonna be networking with people that have a larger company than you, and you're gonna learn ways they got there that you didn't know. And I guess I would say one last thing is that it's when you own a business and you're in your 30s or 40s or 50s, it can be hard to make new friends. And the EO guys are my friends. And I say guys just because my forum is all male. So they've become good friends. We just got back from a trip where we all hung out and did jet skiing and had some good forum activities and went fishing, and just good camaraderie.
I bet a lot of entrepreneurs are listening and thinking, oh, jet skiing, like there's time for that, which I love, Max. What I love most about your answer is the reality of it, that there isn't, we often feel as entrepreneurs, there isn't a lot of time. We don't have enough time to dedicate towards ourselves, whether it's our personal growth or taking time with other business owners to go on a forum retreat where you're jet skiing and kind of building that community, those holistic aspects that really help us then to turn around and pour back into our businesses. So hearing you emphasize that making the time for that is something that you would recommend.
I don't know that if an owner doesn't, I mean, a lot of folks, they can strike it gold on certain innovative products or whatnot, and that can take them very far. Our business model, we don't have, our products, or I guess our clients, and we sell. I tell folks, we get our clients, we get rid of them, we don't get them back, right? It's a terrible business model, right? So and I think in general, if you don't have that time to reflect, your headspace goes away, and then your mental health can deteriorate quickly. And I think also that reflection on what are those high value tasks, and what are those high value uses of your time, I think that's where you can get some ideas about scale. And if you don't scale, you can't create a lot of value, and you also have a hard time. You have a hard time getting out of the day-to-day of your business. And I guess I don't want to be 65 and look back and say, what just happened, right?
Mm-hmm.
That's part of it.
Max, one last question before we go. You are keynoting an upcoming EO event in February. Give us one little sneak peek at what we can expect from you at that event.
Kind of hoping that there's a little bit of bragging rights I can get out here. I mean, I said we've been Inc. 5000 for 4 years in a row, and not a lot of companies are able to do that. And so I would like to show, to the extent that folks are interested, just what have we done to grow as quickly as we can. And again, I say we, it's not just me. I have a really, really solid team around me here, and there are a lot of different elements to rapid growth. And I hope to just share what some of those key factors are that have taken us, at least this far. And I firmly think it'll continue. I think we'll be able to continue to stay on the list. My goal is 10 years in a row. That's a very difficult feat, but that's what I want to do.
And Max, you have some great resources on your website, caldergr.com. We will link to that in the show notes so that our audience can check out and learn more about you and your team at Calder Capital. Max Friar, thanks for being on the show today.
It's been great. I appreciate it.
That's all for this episode of Expert Connections. Stick around, make sure to subscribe, and then jump over to the next video in our playlist.